Well, the panel is not sitting in the order of presentation. We're going to start with Ron O'Hanley. And Ron is the president and chief operating officer of State Street, and previously he was the chief executive officer of the State Street subsidiary that manages the investment, State Street Global Advisors. And Ron is a student of corporate governance and someone who has given a great deal of thought to ESG and sustainability. And just recently, he became involved in one of these very interesting disputes. Phil Graham and others in the what I'll call active investment management world raised an issue with respect to whether it made sense for any investment manager to take ESG into account in investing, and whether this wasn't more politics than investment management. And Ron and his colleagues came back with what I consider to be one of the best responses to that question. And with that, I'm going to introduce Ron, who will talk about value and values.
Well, thank you, Marty. And the other thing...
Move it closer because yeah.
Okay, how's that? Great. My real distinguishing characteristic is that I get to work with Rocky Kumar every day. So Rocky makes us all better as a result of what she does leading our stewardship. So Marty talked about this whole idea of value versus values. And, you know, it sounds like a play on words. But it's a pretty important and, you know, obviously we thought harsh accusation that what's really going on here is a bunch of money managers playing politics, because nothing could be further from the truth. I mean, the way we think about stewardship fundamentally is that most of our investments, certainly from an AUM and assets under management perspective, are long-term, right? We run a lot of index-based funds. So it's by definition, as long as something is in the index, we're going to be invested in that particular company. So I always like to say that, you know, there's a lot of people that purport to be long-term investors. We truly are the long-term investors, because as long as it's there, we'll be invested in it. That's a little bit of a double-edged sword if you think about it, though, because as an index investor, what we're meant to do is replicate that index. If an active investor, say Jeff, decides that, you know, I've got an investment in my portfolio, but it's just not working out the way I want, I can't stand the management team, Jeff's got the option to, but he always makes his investments turn out well, so he doesn't have to do this, but Jeff's got the option to say, we're not going to be invested any longer. I can't do that. We can't do that. I can't systematically or decide, wake up one morning and say the S&P 500 is going to be the S&P 498 because there's two names I don't like. So stewardship for us is this recognition, first, that it's long-term, and second, that our lever is not to disinvest, but our lever is to engage, right? So that's why you're getting the letters that you're receiving from my firm, BlackRock, Vanguard, and others, because it's really about this. It's about we've got this set of beliefs around what constitute long-term value creation. It's not limited to things like what was your quarterly, you know, EPS growth. In fact, it's far from that. Almost by definition, it has to take into account things that we don't think of today. I mean, if you think of the definition of risk is nothing more than more things can happen that will happen. If you're a long-term investor and you're here you've got a horizon that's basically forever, or for as long as that company is around and in the index, then you've got to have a pretty broad definition of risk and what are the things that can happen. which, again, by definition, starts to get into things that go way beyond what you might think as a traditional, are our revenues going to grow or the costs going to be lower, therefore is our NIBT and EPS going to be higher? You have to start think of things like, I'll use the example of climate change. It looks like there's about 150 people in this room. There's probably 150 opinions on what are the implications for climate change on this little patch of New York over the next 25 years. That's the definition of risk, right? More things can happen than will happen. But if you're an investor in a company, what you want to be sure is that the company, with good oversight by the board, is thinking through what are the kinds of things that might affect my company, what I'm trying to do over this period of time as it relates to climate change. And that's just but one little thing. Now, the realities are that we've invested in a total, Rocky will correct me if I'm wrong, of about 7,500 companies around the world. So we can't get as prescriptive as everybody might like us to be in terms of company A needs to do this, company B needs to do that. That could be a next stage for us, but right now that's not where we are. So we deal in principles. Principles, not values. Principles in terms of what are the kinds of things that we're looking for here and by the way, it's always about the board, right? We think that if there's one thing that needs to be done right in terms of really getting this focus on long-term value creation, of which ESG is part of it, is if you have strong and effective and independent board leadership and oversight. So it's always about the board, it's always about a set of principles, and it's always about how do you think about the long term, have that risk aperture wide enough, which by definition is going to bring in factors that might not traditionally in the short term be driving stock price, but in the long term will have something to do with value creation. So why don't I leave it there?
Ron, what do you expect from a company that you have a typical investment and you own 4, 5, 6% of the stock of the company? What do you expect them to show you to convince you that they are dealing with these risks in the proper way?
It's what we're looking for, Marty, ideally, is evidence that the board has a handle on these things, that they're working with management on these factors.
And how do they show you that the board has a handle on them?
Yeah,
do you want to see the board?
Yeah, oftentimes we do want to see the board, particularly on things like board composition and how the board is thinking about governing itself. But oftentimes for things like climate change, it's just, how are you, the board, thinking about it? Mm-hmm. What committee is working on this? What's the type of work? What are you seeing from management on this? Is it incorporated into the strategic plan? And again, it's less about, for us, it's less, again, given the number of companies we're dealing with, it's less about we're going to opine on whether or not that was a good report of, is the board doing its job in this space?
So you would like to have the opportunity to talk, if not to all of the members of the board, at least a representative sample of the board, about how the board is looking at this, how they're looking at management strategy with respect to it, and what they view as the right way to proceed with respect to it. But how do they satisfy you? Can they do it by sending you an annual report or a quarterly report with respect to how they're dealing with it? Or do you think that they should make some arrangement for not necessarily you personally, or not even Rocky, but one of Rocky's colleagues to attend Investor Day presentations or visit the board when there's a board meeting and it's a convenient venue?
Yeah, I mean, that's exactly what occurs, right? And again, it's not equal time to all 7,500. And Barbara will have a lot to say on this in terms of the process also. But we obviously have to operate in a cap-weighted way ourselves, so we're spending more time with more frequency with the larger companies. But it is about visiting. It's about them visiting us. It's really, though, I really want to make sure I make this point, that what we're testing for, if it's one thing we're testing for is the board effective in its governance and oversight? Is it independent of management? And is the board in total a strong board? Strong meaning strong in capabilities, strong in intelligence, and it's not that hard to evidence that. It's certainly pretty easy to figure out the absence of it, let me say that.
Well, maybe I'll turn to Barbara, since you mentioned Barbara, of course, is a founder of BlackRock and vice chairman, and for many years she has really been in charge of public policy, global strategy, and I think it's now global stewardship as well. So in large measure, Barbara sets the parameters of BlackRock's view of how companies are responding to BlackRock to gain their stewardship approval of what companies are doing. So this January, your co-founder, Larry Fink, sent a letter to CEOs of 500 companies saying that what we're really interested in is, what is your purpose? What is the purpose of the company? And purpose has become one of those great words today as a result of that letter. Purpose is really, I think, a synonym today for ESG, sustainability, and focus on doing the right thing from both a value standpoint and from a social responsibility standpoint. So is that what Larry was aiming at? Is that what you're looking for? And how do we show you? If somebody like me comes along and I have a client who has some doubt, what do I tell that client to do to make sure that BlackRock is really behind that company?
Okay, well, first of all, thank you for inviting me. And just as Ron said, I am fortunate to have Michelle and Michelle's whole team supporting me in what we're doing, because they really have just an amazing wealth of knowledge and expertise. In terms of Larry's letter, I joke sometimes, and I say, what letter? But I guess all of you have read it. So I'll just start by saying, one of the fascinating things about the letter is that it wasn't his first letter. There's actually a series of letters. There was 1 year gap. I'm not sure why we didn't have a letter that year, but we've had now a series of these letters. If you line them up, they're actually remarkably similar, but somehow this year, this one went viral. And I'm going to come back to that because I think it's a very important point to understand the letter and then to see how that letter got taken in today's environment. So I'm going to break the letter down into a few parts. There's the purpose part we're going to come back to. But what he also said is, when you look at BlackRock's business, and our business has grown a lot, and especially in the index side, we now have about a 90-10 split. 90% are index assets and equities, 10% are active. So still a very large active book, but dominated by the index. That means we have the same problem Ron has. If it's in the index, we're going to own it. If we don't like the business they're in, we're still going to own it. If we don't like the management, we're still going to own it. Whatever it is we don't like, we're still going to own it, because we don't have that luxury of an active portfolio manager selling it because you don't like the value or you don't like something about the company. That changes the importance of the engagement. It does mean it's the key lever to express the things that you have concerns about, whether it's compensation and you want to have access to the compensation committee or the chair of the compensation committee, or it's diversity, which Rocky talked about, and what is the composition of the nominating governance committee and who's on it. Maybe you want to have a conversation with one of them or the chair of that committee. So this whole idea that you have very few levers if you're an index manager, and Yet you can vote, right? You can vote. But voting shouldn't be the first thing you do. Engagement is important because we believe that you can make change without just voting. And I'll use as an example, because it's very hard to measure, I'll use as an example, if you think back 20 years ago to your clients, how many of them did their board have a bunch of sitting CEOs who all sat on each other's boards? That was the standard 20 years ago. Now say today, how many of your clients, a sitting CEO sits on any outside boards, one outside board, not two, right? That the standards have changed, and why have they changed? Because of engagement. Because investors have said, now wait, that doesn't make sense. That doesn't work. I want to see board members who are engaged in the company, who know what the business is, who are challenging management on some issues, who are not so distracted with their own business or something else going on that they can't be doing a good job as a director. So that's one piece of it.
Ron, I'd like to ask you the same question I asked Ron. How do we show you that our directors are engaged?
Well, we do ask for access to directors in certain situations.
And how is that access effectuated?
We talk to them.
So you want the ability to call
Yes.
a company's directors and say, we'd like to talk to you, or
Yes.
we'd like to see you?
Yes.
And do companies volunteer to bring directors to you?
You know, I was at Society for Corporate Governance this morning, as there's all these corporate secretaries, and the question was asked, and it's very interesting. Again, go back 20 years, how many companies had an IR function at all, right? Today, how many companies don't have an IR function? It's not zero, but it's very few. So the same thing with making directors accessible. 10 years ago, I think it would be very unusual.
Right.
Today, it's less and less unusual. And it's, again, you don't want to come to their board meeting, meet with their whole board, but you may want to ask specific board members things. Our own
And you would
board-
look askance, I take it, if a CEO told you, no, he didn't want to bring a director with him. He doesn't think it's appropriate for directors to have direct
I think
communication.
we would try and persuade that CEO, and I won't say him because it could be her. We would try and persuade that CEO of why we wanted to meet with the director and why we wanted that direct conversation. But let me come back to the
Sure.
purpose part. Okay, so you said purpose is a euphemism for ESG, and I don't agree. I say purpose is partly a way of expressing long-term strategy. Okay? Now, we talk about governance, we talk about environmental, we talk about social. We're not trying to turn companies into NGOs. Companies are in business to do a business. Some of those businesses you might not even like. So you can't say that purpose is going to turn all these companies into something that they're not. But we do want to see companies thinking about reputational risk, about regulatory risk, about operating risk. We want them to be running their business in whatever their business is as well as possible. We want them to be thinking about other stakeholders. So people get into the Milton Friedman. Oh my goodness, Milton Friedman, he's probably rolling over his grave. Okay, I grew up in a very simple retail business. And my dad, people would come in, they had worn their shoes, right through the sole, and they'd say, Mr. Goldman, these didn't wear well. I want my money back. And I think, this is crazy. This person is just ripping us off. And my father would say, no, I'm going to give them a credit because that customer is going to spend more money. They're going to tell their friends to come in and shop here, and they're going to be very loyal customers for many years. And he was totally right. Totally right. And I think if you think about stakeholders in that kind of context, do you treat your clients well? Do you rip your clients off? I don't think that's a good long-term strategy. How about employees? We have a low unemployment rate. We have rising labor participation. We're going to run out of people to hire if we don't allow any immigrants, right? So what are we going to do here? You've got to have some strategy as a company to attract and retain employees. So part of purpose is how are you managing your business? How are you treating all of those stakeholders? And it's not about Milton Friedman versus Larry Fink. It's just common sense. How do you run your business from a long-term sustainable perspective? Not how do you maximize profit for 1 quarter or 1 year, but are you going to be in business in 10 years, and in 20 years, and are you going to be flourishing?
So purpose is sustainability. It's dealing with employees, customers, so on. And purpose is really a euphemism for all of that.
Long-term strategy, I would say,
Yeah.
with a conscience to it.
So while I was sitting there a little while ago, I said, what is purpose? And it has about 30 different items on it along the line you were talking about. That is what is happening today, right? Insofar as the sophisticated investors are concerned in viewing their portfolios of companies and what they have to be concerned about with respect to the business of those companies. And purpose is really a euphemism for we're concerned about your overall strategy with respect to every aspect of your business, and we want to know that it is being carefully looked at, not just by you, but by your directors, and your directors are satisfied with what you're doing, and that your board is diversified from an ethnicity standpoint, a gender standpoint, experience standpoint.
Right, so we would say what we're looking for in boards on diversity is diversity of thought. Now, there's some things that are visible and easy to measure, but that's a flag to have a deeper conversation, okay? It shouldn't be so much rules-based as, well, tell me about your diversity. If you look at our website, there's nothing that we talk about and ask other companies about that we're not comfortable about what we're doing ourselves. Our disclosure shows, how many people we have that are either non-US citizens or dual citizens. We're running a global company. How many people are, how many women do we have? How many independent directors? How many are CEOs or retired CEOs? We're interested in the board composition. We want people who are qualified, who have time, who have interest, and who are engaged.
Let's go back to qualified. You're interested in directors who have expertise in the areas in which that company is involved?
Well, let's think about it. Let's say one company might have operational issues, they might have marketing issues, they might have regulatory issues, they might have cyber issues. The best board is one where, think of it as you're putting a puzzle together. It's not any one piece. Yes, you want strong individuals, but when you put that whole picture together, does it all fit together? Do you have the right expertise in the room to think about different issues that the company face? Can the CEO turn to some of those board members, ask them for expertise and for insights, even outside of board meetings? It's the mixture.
Okay, now, Michelle is overlooking, 9,000 companies altogether?
9,000, Michelle? 15,000.
15,000
Thank you.
companies.
I
Okay.
thought it was low. It's a
Sorry
global-
to...
it's a global business,
I
Marty.
apologize for estimating the number of your problems.
Michelle
I think
personally- Michelle
clearly
personally is not
has a much
doing-
bigger job than I thought she had.
Okay, so Michelle personally is not dealing with 15,000 companies.
Well,
But,
that's
the
the
third part of the
point.
letter,
That's
the
the
third part of
point.
the letter talked about us increasing our resources in this
Yes.
area. We already have today about 40 people, and when we look at increasing resources, it's both people and technology.
Okay.
I mean, in order to do what we're doing, you need to invest in technology. You need to be able to do this at scale. Do you have the same kind of engagement with every company? Of course not. Some companies you look and you say, well, I think everything's fine there. I don't really have a lot of questions. Other companies you say, well, one of my friends sitting here in the front row is starting a proxy fight. Maybe I should meet with both sides.
But here I'm a company, and I'm just going along. I don't have a proxy fight on hand. I'm just, but I'm not the best company in my industry or anything else. What do I do to maintain my, creditable relationship with?
Well, I hope you
Black.
strive to be the best company in your sector.
But I struck out. Just, what do I do? What do I do? I'm not that good.
Well, one
I'm
of the
not that
things,
good.
One of the things that was really
that good.
interesting this morning and here is at the society meeting, they had a whole panel about all the different standards and reporting and now entities who are judging companies and coming up with ratings. And the alphabet soup of entities was shocking. And I mean, I live it every day, and I think about it, and it concerns me. But hearing that panel talk about it, and there was one person who presented this like it was normal. And I'm thinking, you know, we hear from companies survey fatigue. Well, what's happening is we now have all these different entities, some of them NGOs, some of them for profit, that it's become their business. And none of them want to merge, none of them want to come up with one set of standards. They all want to have their own, right? They all want to, well, that doesn't work, because if you have 15 sets of standards, you have no standards. So we actually, one of the technology things is we're gathering in all sorts of data from many, many different sources, and then trying to cleanse it and make sense of it, which you can only do with technology. But today we have so many different groups assigning ratings and different groups setting frameworks. This doesn't really work. It's not sustainable.
Okay, well, as you might have expected, that was a lead-in to my turning to John, who's here with a 50-page sustainability report that he's been issuing each year for 20-odd years. Is the CEO of a company that has been run on a sustainability principle since it was founded in the early 1930s. Last night at dinner, the question came up about whether sustainability had resulted in any decrease in profitability or value. And I was the one who said, since I know the history of the company fairly well, I said, well, your answer, John, is the company was started with a second-hand delivery truck, and now we have a $25 billion company. Yes. So sustainability has served us fairly well, but everybody was invited to take one of the beautiful sustainability reports that John issued last year. So, John, let me turn to you and tell us about how Hess deals with sustainability and what your experience is with the investors who you deal with. And John was wise, just as you brought Michelle, he brought Jay. Jay Wilson is sitting there, who is Director of Investor Relations. So if John doesn't say it just right, I'm sure Jay's going to stick his hand up and give us a signal. So, John?
Thank you. Thank you, Marty, for asking me to participate, and I'm very much happy to be here on the panel with everyone. I think in terms of our commitment to sustainability, values are the foundation in terms of our commitment, and also really underpin our sustainability report. Values, at the end of the day, define you as a person, define your family, and define your company. And there's a reason in our sustainability report, the first page, and the report's been distributed, so hopefully a number of you have it. The first page is our values. It really is so important to make clear what do you stand for. And values don't change. Strategies change, but values don't change. They're the bedrock upon which you build any organization or any enterprise. So what are our values? First, it's integrity. Next, it's people. Then performance. Then value creation, social responsibility, and independent spirit. In a land of the majors and the behemoths, being an independent, we think, actually is an advantage, and it's part of our culture. So at the end of the day, you know, social responsibility is a key driver and a core value to really drive our commitment to sustainability. And that sustainability really drives our long-term strategy, how we operate, and really it's essential and fundamental to being a successful business enterprise, so it's part of our DNA. Our focus on sustainability goes from the boardroom to our leadership team to every employee in the company. Our board is very knowledgeable about our sustainability risks. They're climate change literate. We bring in outside experts periodically to really inform them about the risk of climate change. We also use climate change and our sustainability risks in terms of making our strategic decisions, looking at various scenarios, as well as, putting a price on carbon to make sure that the oil that we're trying to find and develop and produce over the next decade will still be needed. And at the end of the day, we have an EHS committee of the board that oversees our sustainability risks and our practices as well. I think it's also important that in terms of our compensation system, including my own, but for every employee, that sustainability metrics are used for a meaningful part of our pay, over 20%. And, that motivates the workforce and makes sure you're managing what you're measuring and motivating people to have the right outcomes. And we look at it at the asset level, we look at it at the corporate level as well. In terms of the sustainability report itself, Marty, you mentioned that, we started in 1997, over 21 years. We use GRI. I realize different people have different standards for how you communicate and hold yourself accountable for performance, but we use GRI, which we find to be the gold standard. And it's about transparency and performance and showing our progress each year versus the targets we set. We're honored and delighted and really proud of our every employee in the company, but especially our team that puts that report together, because we've gotten a number of awards, and it's not just Johnny-come-lately kind of thing. The Dow Jones Sustainability Index, we've been selected for the last 9 years, and we're one of 4 oil and gas companies that are on the list, and we're what they call a mover, a leader in the area, and we're very proud of that. We're also, for Corporate Responsibility Magazine, one of the top oil companies. Again, I think there are 4 of us, and we're one of 100 companies that have been selected for that recognition for the last 11 years. So I think that's really important because, getting people to recognize it also motivates our employees that they're, doing the right things the right way. Also, 2 of our largest shareholders are here, and we engage with them every year. We had great meetings with Rocky as well as Michelle. And, that engagement is really important because getting their feedback, getting their thinking obviously has an impact on our own, and we try to incorporate their best ideas into our practices.
John, do you bring in outside directors?
Yes, we bring Jim Quigley, who's our chairman. And it's very important that the board is represented at that meeting. So definitely an engagement is the board and also the CEO.
And do you give the investors who you visit an opportunity to meet with the directors?
Yes, we do.
By them without you present?
Yes, we absolutely do. And I think that's a very good practice to do. So the board, without any filtering, here's what's on the mind of your shareholders. Right. So we encourage that, actually, and we invite it. So I think it's really important that we have that engagement. We also have the independence of the board, getting that feedback, and we incorporate it into our sustainability practices and the practices of our company on many dimensions. In terms of what we focus on in the sustainability report, I'll boil it down to, I'd say, 3 key areas, even though there's a lot more said in those pages that Marty just mentioned. One is the area of safety. Obviously, license to operate is key, and safety is foremost on people's minds. We always start meetings with safety when we have any of our meetings, be it a board meeting or a leadership meeting with our employees. And our safety recordable incidents has gone down 50%, over 50% over the last 5 years. In terms of environmental stewardship, our Flaring has gone down about 40% in 5 years. Our spills have gone down 50% in 5 years. And fresh water usage has gone down 35%. We were talking earlier about it being about efficiency, but it's also about having the license to operate, and it's very, very important. And I think it's also important to know that we're always looking to continuously improve. So I think among our peers, we're the only company that has actually set targets for reducing greenhouse gas emissions. And we keep moving the bar on that to continuously improve. So
Let me just interrupt you there, because I think you made a very, very important point. We should emphasize it. Everything you mentioned with respect to safety and dealing with the flaring and the water and everything else, that affects your profits too, doesn't it?
yes, it does.
So you're actually increasing shareholder value while at the same time you're satisfying concerns with respect to the environment.
Absolutely.
and
Sustainability, is definitely good business, but it also drives shareholder value.
So you don't see that there's a tension there between shareholder value and sustainability. Actually, sustainability is an aspect of increasing.
It enhances
shareholder-
returns.
Yeah.
Absolutely. And, in terms of
So
social...
why doesn't everybody do it?
I'll let the other people answer the question. In terms of social responsibility, our company has always had a commitment to investing in the communities where we do business, to having a positive impact on those communities. We really think that's good business. It's in the areas of education. It's also in terms of healthcare, and it's sort of the DNA of the company, and we've spent over $100 million the last 5 years in social responsibility. And in terms of education, we have education programs in Equatorial Guinea, in Ghana, in North Dakota, and also in Houston, because we really think by investing in education, we're preparing the workforce not only in the community, but it also helps our company to have a more capable workforce. One story I'd like to tell is about Equatorial Guinea, a country in West Africa. It's the only Spanish-speaking country in Africa. We've had an oil production operation there that we recently sold, but we were there for about 15 years. And about 15 years ago, I met the president of the country, and I said to him, how can we help? How can we invest in the community? How can we help you, basically improve the prosperity of the people of Equatorial Guinea? And I happen to speak some Spanish, and he said, "No darme pescado, enseñarme pescar," which for those of you that don't know is, don't give me fish, but teach me how to fish. Now, unfortunately, my Spanish wasn't good enough. I thought he was telling me to eat fish. But fortunately, some people helped me afterwards and said, no, it's the same idea in English. And he was really saying, help me in education. And what people don't realize in Equatorial Guinea, out of 1 million people, 60% actually it's 80% of the children don't go past 6th grade. And so the literacy is depraved, and they're really in a downward spiral in terms of lifting their people up. And I'm very proud to say that our company, working with the country, started a $100 million program. I understand it's the largest public-private partnership, and it's been over a 10-year period, half spent by Hess, half spent by the government. And we've trained over 1,200 teachers. We've touched the lives and educated 135,000 students, and it's a program we're really proud of. And we try to do programs like this to make a sustainable difference in the societies and communities where we do business.
John,
And-
do you personally visit each of the communities where you do business?
Yes, absolutely. And I think it's incumbent upon the CEO and leadership of a company to do that. And I think it's actually incumbent for that CEO to also work with the head of the country to try to work together to find common ground to build sustainability practices, not just for your company, but for the country or community at large. So I'm giving these examples just to give you some insights into what makes us tick. But at the end of the day, sustainability is a driver of shareholder value. It's in our DNA. And, when we think about, what our commitment to sustainability is, it really underpins our purpose. We were talking the word purpose before, and our purpose is clear: to be the most trusted energy partner in the world. And obviously, it's about finding oil and gas economically. Obviously, it's about generating superior financial returns. But it's also about creating value for all our stakeholders, be they investors, be they employees, be they business partners, or as well the communities and people where we do business. And I'll give you two examples just to wrap up where it's really created value. Exxon had an opportunity in a country called Guyana that's directly east of Venezuela. It's offshore, the opportunity for some drilling. And we approached Exxon about 5 years ago and said, we'd like to be your partner here and obviously share risk, contribute our capability. But one of the things that I think distinguished us, especially in the land of the giant oil companies, was our commitment to sustainability. That's what Exxon told us. And they brought us in as a partner, and it's turned out to be, obviously game-changing for a company. It's pretty much doubled the size of our reserves, some of the largest oil discoveries in the last 10 years. So my point in bringing this out is our commitment to sustainability really makes us a partner of choice. And the fact that, Exxon has a high bar for who their partners is, we're honored that they took us in. The other area is a number of times when we're talking to investors and they're thinking about getting some weighting into energy, they'll say, well, what are you doing in sustainability? Show us. And in fact, you should not only have a sustainability report, but put it in your investor presentation. In a number of cases, investors have taken a shareholding in our company, obviously because they like our strategy, but also because of our sustainability practices. So at the end of the day, we're committed to sustainability. It's part of our DNA. It drives a lot of shareholder value, and at the end of the day, it gives us a license to operate.
Could I just take 1 second to
Of
answer
course.
Jeff's question a little bit? So the difference is long-termism, right? John, it's his family. He plans to be there a long time, right? He's not thinking about how do I maximize the next quarter. He's saying, how do I make sure this thing stays there? What is the average tenure of CEOs?
Less than 5 years.
Right. So you've got a baked-in problem, and I think if we can get the boards, at least, to force a longer-term thinking, you will have people saying, oh, sustainability does increase value. And I think that's sort of the key thing, and that's why when you look at Larry's letters, all of the letters are about long-termism. And that is the theme, is if you can get a longer holding period and a longer time horizon for everybody involved, I think you end up with a better outcome.
I agree
It
with that.
also increases the span of the CEO.
Okay, Marty, can I go? That's a good segue. You don't have to. You don't have to ask a question.
I want to introduce you.
Don't worry about that. Go ahead.
You're going to love the introduction.
No, I don't want to hear it. I
Don't
don't wanna hear it.
step on it.
I don't wanna hear
Don't
it.
step on it.
I'm going to start. Okay, I'm going to start.
No,
Yeah.
Jeff heads Value Act, very successful fund, sometimes called an activist investor, but I don't view Value Act as an activist, and after you hear Jeff, you'll know why I don't. I tell Jeff that he's not an activist investor. He's really a merchant banker, an old-fashioned merchant banker who has an investment in a business for the long term and works with that company in order to improve the company over the long term. And with that, I'll give you the
No, that's
floor,
good.
Jeff.
So Bob opened the conference by saying that he's the least qualified to be here. Well, I am the most unworthy. I honestly have been, until recently, I've been in the business for 30 years, I have been a dedicated advocate of one constituency, which is this, the primacy of shareholder value. Value Act was built on the concept that owners and board members should know each other, which didn't exist when we started. They should learn from each other, and they should trust each other to create value independent of the market in their sector. And it works. If you let ValueAct into your room and you give us all the information, together with the information we bring from the outside, and you give us time to lead fact-based decisions or be part of fact-based decision-making with a room of talented, smart people, other board members and management, we will get to the right place. We will create value. Now, the governance cycle, which started, I think, in 2001, 2002, when ValueAct started, and Marty's evolved this, it has evolved, it's matured, and it forked left in the wrong direction recently, in my opinion. You kind of went from this period in the early days, the pendulum was probably too far to the side where you had too many entrenched boards and managements, to today you have the bully owner who's motivated and paid on short term. Now, I have been complicit with this new fund that Eva and I are working on, try to find companies whose core competency collides with a social and environmental need or problem. Go on the board, encourage them to invest more, not less, invest in flaring, go faster, be a leader, and solve the problem. I want to be the celebrated story to Rocky's outliers that she goes after. And I think if you think about stock prices, which is essentially a discounting mechanism with most of the value residing in terminal value, it just makes sense to me, if you listen to Barbara, it just makes sense to me if you invest more today and you take on big social problems and big environmental problems, and you're identified early as one of the leaders in solving that problem, you're going to create the sort of terminal value that makes you tomorrow's growth company in a significant and huge way. And then you get the sustainability premium, and one by one, as we celebrate successes and tell the stories, which is what we want to do, I think you can change corporate behavior. That's the only thing I know how to do, is kind of company by company. So that's how we're doing it. We have 7 investments. We've got a company that's making adult education more affordable using artificial intelligence. We've got a couple companies in energy deploying renewables and, most interestingly, storage. So I was in Hawaii and we were doing sunlight at night because all the lights were on, but they were running on batteries. I mean, this is fabulous stuff. Technology is allowing this to happen. They've gone down the cost curve. The companies need to be able to deploy it, and that is costly. And it's probably margin today. It's an avoided share repurchase tomorrow. But they want to do it. They want to do it. They just need somebody to be in the room and say, you can do this, and it's going to pay. We may need 5 years, but we're going to be tomorrow's company, not yesterday's company.
Jeff, tell us about anything.
I do. I want to change the conversation a little bit. A lot of focus on asset management and sustainability is on stewardship. The way we look at it, it's one of several pillars within sustainability. And not enough time in any of these events gets spent on who are our end clients and how do they think about these things. So, we're finding more and more clients are asking about sustainability. They're asking about ESG scores. They're asking about how do we use ESG data? How do we integrate it into portfolios? And then some are saying, I want to allocate my capital differently. So there's this perception sometimes, and I'm sure Ron's had the same thing, but there's this perception that Larry could wake up one morning and say, put it all on gold, or, let's take a big chunk of these portfolios and put it in wind power. That's just not how it works. And yesterday there was a big announcement that we're hired to do a new alternative energy thing. But the money is not our money, it's client money. And I think that's a component that needs to be better understood, whether it's at the academic level or it's in the community more broadly. And then the fourth pillar is people should be asking asset managers how they run their own business, right? So I told you about our board. Well, ask asset manager about energy. Jeff just mentioned Microsoft went to renewable energy for the data centers. Well, you know what? We did that. We have two of the most energy efficient designs, and we use hydropower. So what are other people doing? That's part of the energy pig of running an asset management company. What are people doing about things like electronic delivery? We lobbied the hell out of that to try and get a great energy save, environmental save. Fewer trees cut down, less paper printed, less delivery, less landfills. It's like a home run. And by the way, it saves shareholders money. So, what are people doing to demonstrate that they are really concerned about the environment, not just checking some box on a form? And the same with social policies. How are you treating your own employees? What are your policies? What are your training programs? How are you attracting and retaining people? What benefits do you offer? And how do you live and act in the communities that you live and work in? And I think, John's points, what are you doing? And it's not like this social give back, but how are you behaving? Simple as that.
I think that's very, very important. I'd just like, so you really deal with two types of stewardship. One is the stewardship that you are providing to the people who give you their funds to invest. And you want to know exactly what their objectives are so that you can then determine the other aspect of stewardship is how you act toward the companies that you allocate their funds to for investment. So you're kind of in the middle of stewardship. On the one hand, you're a fiduciary for the people who have entrusted their funds to you, whether it's indirectly through indexing or directly through active management. And on the other hand, you are a steward with respect to your power to vote the shares of the companies in which you invest and thereby impact their strategy, their performance, and
Right.
so on. So you are in effect in double harness as a fiduciary.
Right. There's also, ESG today is not just about stocks. There's green bonds. There's actually even green cash, if anybody wants to talk about it.
What is green cash?
Well, just looking at the company and what are the ESG characteristics of that company, and you might favor the commercial paper of one versus another. It's actually becoming much more ingrained in all of the investment processes and people really thinking about these things. And it's driven primarily by the clients. That's where it starts.
Now, how would you relate that to Senator Warren's bill, which would federalize corporate governance for companies that have revenues over $1 billion? Isn't that the political issue of the moment or the future?
Define federalize, what is that exactly?
I'm sorry?
Define federalize.
That the federal government would regulate the company. In other words, the federal government would establish the kind of fiduciary duties that the state governments now provide
Got it.
in their corporation laws, which define the duties of directors and so on. But it seems to me that ESG, sustainability, social responsibility, climate, all of these have created a political issue as to where are we going to look for the legal aspects of going forward with corporate governance. Is it going to be the federal government? If you look at Europe today, the EU, the EC, are coming out with laws, call it that, regulation, that have the impact of the fiduciary aspects we've just been talking about. And is that going to continue to grow so that both the investor and the company are going to have to be responsible to
Can I jump in?
greater regulation than they have now?
Are you familiar with the bill?
You know, I'm just going to specifically say, I think there's this awesome tension right now between the way our country trusts market forces to solve problems, to the kind of as we avoid policy, which obviously you're talking about essentially.
I'm talking about policy.
And I think the two problems with with behavior change at the corporate level and the customer level is the customer is not getting a price signal on their product because there's a carbon embedded in the plastic bottle for the water we sell you, but they're not forced to pay for that. So it's too cheap, and the environment is free, and that's wrong. So the consumer's very difficult to nudge until we get a carbon tax, which is back to policy. The corporate behavior is ready. The CEOs are ready. The board members are ready. The index funds are ready. But the investor class, specifically the short-term payouts that accrue to the investor class, the active investor class, is the problem.
So, Marty, I would answer a little bit differently.
Yes.
The U.S. has incredibly deep and liquid capital markets. The bill that's proposed would dramatically change every aspect of corporate law, corporations. I wouldn't undertake something like that lightly. If you look at Europe, they have something called Capital Markets Union as an initiative. They would like to have deep and liquid markets like we have. So I don't know that having regulatory convergence is necessarily the solution. And I think a lot of these things are not really best solved through regulation. And I do use the example of the corporate boards and the CEOs and sitting CEOs. There's a sea change. A lot of times people want to wave a magic wand or snap their fingers and somehow something should change overnight. I think some of these things, it's a slow-moving train.
It's too slow, Barbara. We don't have time. It's too slow. We need something else. We don't have any time.
I think it's changing faster than you think.
Well, I think we're in the process of finding the solution to it. If investors,
What do you think?
Ron and Barbara, follow through on just what they talked about today, and companies follow through just as John described, and the active investors like Jeff follow just the procedures and policies that he follows. We, in effect, have obviated the need for any kind of regulation, and we've preserved the system that has served us so well. Problem is, if we don't follow through on that, and there are some of us who think that the activist hedge funds have done a terrible disservice to the overall business and financial community, and have been the provocateurs of changing the regulation. But we can't ignore what's been happening in Europe. There's this new Dutch stewardship rules that came out 3 days ago, 4 days ago. There are very active efforts at regulation and legislation, of which the Warren Bill is an example here, and changing the entire structure by moving from state regulation of corporations to federal regulation. Federal regulation of investors has not worked so well, but if you had federal regulation of both the investor and the investee, the companies,
Then you have state-owned
then
enterprises.
you have state corporatism.
Marty.
That's what we deal with.
I'm not an advocate of that.
No, neither am I. But that's how China works today. That's state corporatism.
Marty,
And totalitarianism.
We're gonna have an
follows
election to
with
decide
state
this, I
corporatism.
think.
Marty,
Yeah,
a
Rob.
couple reactions to all this. I would agree with Jeff that there is a need to act, but I think we have to think about the unanticipated consequences. I mean, in this short conversation, two very extreme and different kinds of solutions have been proposed. Jeff, you basically said, let's make sure that all the externalities are actually internalized, so that this isn't plastic, but if this were plastic, it would reflect the true cost that I'm imposing on the environment by using that. That's one way at it, and I think actually is a good way, because it makes sure then that that the cost of all this is reflected in pricing. Pricing influences all of us, and we're going to make our choices based on that. The challenge with something like the Warren Bill or what's going on in Europe is there is a easy alternative to the public equity markets. It's called the private markets. So,
happening.
Exactly. So to the extent to which that there's a bill that says if you're a public corporation, worth over, whatever the market cap is, the first thing you're going to do is see how quickly can I take it private. And that's got its own set of unintended consequences in terms of who then can invest in it, what kind of transparency there is. So that's one observation. The second I'd like to make, Jeff made a really important point earlier about long-termism, and it's this. Interestingly, when you really look at where the money comes from, right? This money isn't our money. We're investing money on behalf of others. Most of it actually is quite long-term, right? It's DC plans where people, defined contribution plans, people are putting in their money for long, long periods of time. The investors, the true underlying investors are long-term. You've got the people whose money it is. The challenge that you've got is you've got a lot of careerism and compensation that interferes with all this. You've got careerism, meaning that I'm really worried about my job, whether I run a pension fund or I'm managing money for the pension fund. So I really want to make sure that I'm performing on a short-term basis, and I'm actually ignoring the fact that the true liabilities, in other words, what the investor is trying to cover, are long-term. This, I think, is what we have to address, is how do we deal with the measurement period. Now, it's not easy, because it's very easy to measure all of us who are in active management on relatively short-term things. How'd you do relative to the benchmark last quarter, or how'd you do relative to your peers? It's very different to say, you know what, the average term of the liabilities for the investors on behalf of which I'm investing is 10 years. I'm taking a 10-year view here. And I'm actually going to make an investment like Jeff did in Microsoft. Believe me, there weren't a lot of active investors hoovering up Microsoft at the time you did that, Jeff. I mean, that's why the stock was where it was. But you took a long-term view. So it's a hard problem. A lot of people are trying to work on this, but I think until we get this measurement and careerism problem kind of fixed in all this, we're never going to see the alignment.
John, you were
Yeah, Marty, we're talking about climate change. Obviously, we're in the energy business and we have some thoughts on it. Climate change is real. Evidence is higher temperature, warmer oceans that are acidifying, melting glaciers, extreme weather events. And many people have called climate change the greatest scientific challenge of the 21st century. And I would agree with that. And the real challenge is the world's going to probably grow from 7 billion people to 9 billion people by 2040, 2050. They're going to need affordable, accessible, and cleaner energy. 1 billion people are without electricity today, and by 2040, most estimates are that energy demand is going to go up 25%. The IEA, the International Energy Agency, which is pretty good at giving outlooks and scenarios, says that oil and gas will still be 50% of the mix, and that's assuming a lot of efficiencies and reducing the carbon footprint. Renewables will go up to 20% of the mix. The key really isn't the what, it's the how. And where I sometimes get frustrated is that our industry doesn't do a better job engaging on the how. I would ask all of you that haven't read the Princeton Carbon Mitigation Initiative or the Princeton Wedges, you can find it on the internet. It really informs people and educates people about what the how is and the challenge. And they're just Herculean things that have to be done to reduce the carbon footprint while we're growing the world's energy. If you had 8 initiatives, you'd hold, and they call them wedges, you'd hold carbon emissions flat, and if you did 15, you'd actually go down and reduce the concentration of CO2 in the atmosphere. I'll give you a couple examples. One wedge would be going on a global basis from 400 nuclear plants to 1,200. By the way, each nuclear plant costs about $10 billion. Not many companies can afford that kind of investment after Fukushima. I don't think so. You have to take cars from 30 miles a gallon to 60. You have to build 2 million windmills across the world. You have to take a coal plant, convert it to natural gas. Jeff was talking about that. You have to do 1 a week for the next 45 years. You get my point. It's a steep mountain to climb. I'm not trying to rain on the parade. It's definitely a societal big problem, and we deserve for our kids and future generations to leave the planet cleaner than what we inherited from prior generations. The point is, it's a big challenge physically and economically. And how we fund it and the societal choices of cost benefit, these are big debates that we have to have. But all I'm trying to advocate is we build a shared understanding of what the problem is, and then what can we afford to address the problem.
I think
putting a carbon tax on, yes, but one of the issues with a carbon tax, the U.S. is down 10% in the last 10 years in terms of our carbon footprint and CO2 emissions. So is Europe. China's up 30%. The world's up 10%. So we're actually losing the battle as we speak. So even if we put a carbon tax on here or on in Europe, unless we engage the developing world, specifically in Asia, specifically China and India, we're not going to solve the problem. So it's a big problem. I'm just trying to get some clear-eyed thinking to think about it.
I think on that note, we'll conclude with thanking Ed Rock for putting together a fabulous afternoon program.